Two consumer durable manufacturers, Polycab and Havells, have reported their Q3 numbers recently. Let's do a three-point analysis to really understand the earnings fine print and also see which is a better pick for investors going forward from here. 1. Polycab result highlights. Well, Polycab's impressive growth continued into Q3 FY20 with revenues rising 24%. On a segmental basis also, wires and cables revenues jumped 21% due to higher contribution of 381 crore rupees from one of the large size export orders. Fast-moving electrical goods segment also, the sales jumped over here 34% on the back of the strong volume growth in its key products, that is fans and also the lighting segment. Now, a pickup in the project execution drove the revenues in the EPC segment as well. Operating profits growth was weaker in comparison as margins declined by more than 200 basis points. Now, on a yearly basis as well, a significant jump in the advertising as well as the marketing expenditures along with a higher operating expenditure that weighed on the margins. Now, lower corporate tax rate also aided the bottom line in Q3. Now, the domestic demand scenario remains sluggish and the company is definitely eyeing growth through increased penetration in the export markets. Now, on the retail front, the company is undertaking multiple brand development initiatives to really penetrate the domestic market as well. Now, the ad spends would definitely remain high from here, but the economies of scale should aid the margins in the coming quarters from here. Now, for the wires and cable segment, the management also expects the margins to be in the broad range of 11 to 13%, and going forwards, the capex is expected to be around 250 to 300 crore rupees on an annualized basis. 2. Havells earnings highlights. Well, Havells reported a 10% sales decline in Q3 due to the softness in the overall economy, lower government as well as institutional spending, also a reduction in inventory levels by dealers and a delay in payment cycle affected the offtake across all its business verticals. Now, EBITDA fell to 270 crore rupees from 298 crore rupees a year ago, but operating margins were largely flat thanks to operating efficiencies and also cost saving measures. Now, on a segmental basis, the switchgear business was impacted by real estate. Lighting and fixtures had a strong 18 to 20% volume growth in the rural markets thereof, but the price erosion in the LEDs definitely weighed on the segmental revenues as well as margins. Now, growth in the consumer durables continued to taper and also the quarterly revenues came in marginally ahead of last year. Apart from this, cables and wires was hit by lower demand in power cables and also the falling commodity prices. Now, the Lloyd's business had another disappointing quarter. In FY20, the Lloyd's business had lost market share due to the high competitive intensity as well. However, the management is hopeful of a recovery due to the corrective measures being undertaken across the business segments as well right now. Now, the commencement of the in-house AC manufacturing plant would definitely reduce the dependency on imports and also aid the cost reduction from here on. Enhancement of product profile, that is the addition of washing machines and refrigerators along with the augmentation of the distribution network should further support the revenues and also the margin profile in the coming quarters from here on. 3. Where should investors keep their focus then? Well, macro conditions continue to remain challenging amidst a tight liquidity condition as well. Apart from this, the cables industry has been adversely impacted by the lower government spending as well as the weak institutional demand as well. Now, the consumer durable offtake at the retail level is also sluggish due to the downbeat sentiments that we are witnessing. Now, Polycab's revenue growth is mainly on the account of a large 1,000 crore plus export order, which is expected to get completed by Q1 FY21. Now, the business could face some headwinds on the growth front post the completion of this export order. Now, the stock has nearly doubled from its 52-week lows. The current valuations seem to factor in the near-term positives as well. But long-term investors should keep the stock on their radar for accumulating on dips. That's a strategy that you should adopt. For Havells, the weaker trends at Lloyd's business need to be monitored quite closely from here on as well. Now, Havells trades at lofty valuations on the account of its market leadership position, and also the investors should wait until the valuation really cools down to reasonable levels.